Clean energy is a relatively new sector under massive expansion. Some companies are profitable, but many aren't yet, and this sector can be volatile. As far as clean energy ETFs are concerned, this is a high-risk sector. There's no sugarcoating it. But if you believe this sector will continue to grow, then it should definitely be part of your portfolio. A while back, I did a similar video called the best clean energy ETFs. However, those ETFs in particular trade on the New York Stock Exchange and in US dollars. I got a ton of feedback from Canadian investors wanting to know which clean energy ETFs trade on the TSX to avoid any conversion fees going from US dollars to Canadian dollars. No worries, because I got your back. Today, I'll be talking about the two very best clean energy ETFs that trade on the TSX. So that way you can get global exposure, benefit from the growth in renewables, all the while trading in Canadian currency. In the ESG space, which stands for environmental, social, and governance, also covers clean energy. Harvest ETFs and BMO both launched a clean energy ETF in January of 2021. In my last clean energy ETF video, I talked about HCLN. In this video, I'll be talking about ZCLN. Both are identical. HCLN is a US version, and ZCLN is a Canadian version managed by BMO. They track the same index and have roughly the same holdings. Meanwhile, HCLN by Harvest takes an equal weighted approach. I'll be talking about this in much more detail later in the video. The Canadian ETF industry just reached $260 billion of assets under management just in January of 2021. The Canadian ETF product lineup continues to expand seemingly every day. There's a new ETF. Now, before I dive into the two very best clean energy ETFs for Canadian investors, why should you care about clean energy? Today, there are many new environmental protocols that are driving the investments in clean energy. Not to mention, global political policies are highly supportive of the transition to renewables. Societal policies have also made this shift more towards clean energy and away from fossil fuels. The long-term costs of renewables are a lot more attractive, especially when you compare that to the finite resources our planet has to offer. The rapidly falling cost in renewables has also increased adoption and investments along the way. And finally, the global universe of companies engaged in renewable energy is continuously expanding. The first ETF we'll be talking about is HCLN. The Harvest Clean Energy ETF invests in a portfolio of the 40 largest clean energy issuers selected from the Clean Energy Investable universe. The universe includes equity securities that are listed on the select North American, European, and developed Asian stock exchanges that are categorized as renewable energy or renewable energy generation. The portfolio is equally weighted and follows a systematic process in selecting the 40 largest clean energy issuers measured by market capitalization and is reconstructed and rebalanced semi-annually. So what this means is that this ETF every 6 months is reconstructed and rebalanced, meaning that companies that have a higher weighting than their target could potentially be sold off. And the companies that have a lower weighting than their target, the fund will pick up more of those companies. So that way they're always at their target ratio. That's what it means to have an equal weighted fund. So in summary, each of these 40 companies that are in this ETF will have an equal influence in terms of the performance. So that way the performance is not just based on a handful of companies, but rather than the collectiveness of the 40 companies. Harvest believes that the changing landscape for renewable energy production and investments represents a long-term structural change. Looking at the key facts of the ETF, the ticker symbol is HCLN. It was launched back in January 14th of 2021. The management fee is 40 basis points. What this means is that for every $1,000 you have invested in this ETF, $4 will be taken from your total return and will go towards the cost of managing this ETF. Harvest has set a medium risk rating for this ETF. As mentioned before, there are 40 companies within this ETF. It has an equal weighting structure and is eligible for your RRSP, RRIF, RESP, and TFSA. The top 10 holdings make up roughly 31.5% of the ETF at the time of this recording. Because this is an equal weighted fund, each stock in the ETF should be 2.5% theoretically, but as the market fluctuates, these weightings can change. So this is why this fund is rebalanced and reconstructed semi-annually, so each company can go back to its target weighting of 2.5%. The other benefit of investing in an ETF like this is that when companies stop performing, they will be dropped from this ETF, as a mandate for this ETF is to always hold the 40 largest companies that are in the clean energy space. So that's why ETFs like this are considered self-cleansing. When companies stop growing, they are dropped from the ETF, replaced by companies that are growing at a much faster rate. So that way, the top performers will always stay in the fund, and the ones that are not performing will be dropped and replaced by new rising stars. Looking at the geographic allocation, this ETF has investments in companies worldwide, all the way from the US, Norway, Italy, Australia, and so on. However, the bulk of the funds are in the United States at 29%, China at 14%, and Canada at 13%. This makes up more than 50% of the fund's overall weighting. Now, if we look at the subsectors of this ETF, 50% of the investments are in renewable power generation, 27% are in solar equipment and services, and 11% are in hydrogen and fuel cell equipment. This ETF is currently trading at $15.39, down from $19 when it first launched. That's not necessarily a bad thing if you're looking to invest in clean energy, because essentially, you're getting a 20% discount to invest right now. And if you believe the future is bright for clean energy, this is a great time to get into this ETF, especially when it's trading at such a deep discount. The second ETF I'm covering is ZCLN. The BMO Clean Energy Index ETF, ZCLN, has been designed to replicate to the extent possible the performance of the S&P Global Clean Energy Index net of expenses. The fund captures a clean energy megatrend by investing in companies that are involved in clean energy related businesses. Just like HCLN, you get exposure to a global list of companies whose primary business is clean energy. Now, that could be clean energy production, clean energy equipment, or clean energy technology. This index is weighted by a combination of market cap and an exposure score. This index rebalances semi-annually in April and October. So unlike HCLN, where it has to be rebalanced and reconstructed semi-annually, this ETF is just rebalanced in April and October because there is no specific target for each company. The ticker symbol is ZCLN. This was launched back on January 20, 2021. The management fee is 35 basis points, meaning for every $1,000 you have invested in this ETF, it'll cost you $3.50 to have this fund managed. The risk rating set by BMO for this ETF is high, where the risk rating set by HCLN was considered to be medium. There are 30 holdings within this ETF compared to the 40 holdings of HCLN. This is a market cap weighted structure and is eligible for your RRSP, RRIF, RESP, and TFSA. The top 10 holdings for this ETF make up roughly 48% of the fund's overall weighting. This ETF is weighted by market cap structure. This means that you'll benefit more from the largest of the large clean energy companies than compared to the smaller ones. The benefit of this market cap structure means that the ETF does need to be readjusted every now and then. So that way it has the 30 largest companies within the ETF. However, it does not need to be reconstructed like an equal weight structure. Because there's no cap on the largest companies within this ETF, it can let its top performers keep going indefinitely, rather than trimming their weightings to balance out against the smaller companies. Looking at the geographic allocation, you also get exposure to companies worldwide, the largest of which are based in the United States at 33%, Denmark at 8.59%, and New Zealand at 8.57%. You also get exposure to a variety of subsector allocations, such as renewable electricity at 33%, semiconductor equipment at 17%, electric utilities at 17%, and so on and so forth. This ETF is currently trading at $22 per share, down from $29 when it first launched, meaning it's trading at a 25% discount. So again, if you believe the future is bright for renewable energy and you're looking to get into ZClean, this could be a great time to pick up units of ZClean at such a deep discount. So let's take a look at what kind of investors these ETFs are really for. If you're looking for more exposure to clean energy related businesses, this is a great way to get in. It's also designed for investors looking for growth solutions. These ETFs are considered to be a medium to long-term investment strategy. They're also designed for investors looking to align sustainable and responsible values with their investments. You also need to be able to handle the ups and downs of the stock market. And last but not least, you get exposure to the global mega trend of clean energy. Now looking at these ETFs side by side to see which one makes the most sense for you. They were both launched back in January of 2021. HCLN has a higher management fee at 40 basis points than compared to ZClean at 35. Harvest has set a medium risk rating for HCLN while BMO has set a high risk rating for ZCLN. You get exposure to 40 of the largest companies with HCLN, and with ZCLN, you get exposure to 30 of the largest companies. HCLN goes for an equal weighted structure, while ZCLN goes for a market cap structure. They're both eligible for tax sheltered accounts. With HCLN, you get exposure to US, China, and Canada as your top 3 geographic sectors. Meanwhile, for ZCLN, you get exposure to US, Denmark, and New Zealand as your top 3. HCLN is the larger of the 2 ETFs at $48.5 million of assets under management, while ZCLN is at $26 million. The price for HCLN is roughly $15 per share, while ZCLN is roughly at $22. If you're looking for exposure into clean energy, then look no further than these 2 ETFs. They're both very similar, and honestly, you can't go wrong with either of them. The main question you want to ask yourself is, do you want an equal weight structure or a market cap structure? With ZCLN, the 10 largest companies will have a greater influence than the rest of the 20 companies in the ETF. But with HCLN, any of the 40 companies has an equal chance of influencing your performance. So that's what it comes down to. Personal preference. Do you want equal weight or a market cap structure? And remember, when it comes to investing, ETFs do not have any guarantees. You may not get back the money that you invest. This is just the natural risk of investing in the stock market, whether it's picking a stock directly or investing in an ETF. So be sure to do your own due diligence before making any investment decision. This video is meant to be for educational purposes and does not replace the need for professional investment advice. A quick word about tax. In general, you will have to pay income tax on any money you make on an ETF, as long as that ETF is outside a tax-sheltered account. How much tax you have to pay depends on a variety of factors, such as the tax laws based on where you live and whether you hold the ETF in a registered plan, such as an RRSP or a TFSA. Something else to keep in mind, if you hold your ETF in a non-registered account, distributions from that ETF are included in your taxable income, whether you get them in cash or have them reinvested. Interested in free money? I have links to promo codes in the description of this video for various discounts and sign-up bonuses. They also help directly support the channel, so be sure to take advantage of those offers. If you have questions for me, feedback on this video, or maybe you have ideas on future content, make sure to leave your thoughts in the comments. And while you're at it, make sure you hit that like and subscribe button, so that way you don't miss out on any future videos like this. That's it for now. I'll catch you guys in the next one.